Hello everyone, my name is Jordan Alicio, the General Manager at ABC Bullion Australia. Delighted to welcome Jasper Crawley, the Head of Institutional Relationships across Asia Pacific for the World Gold Council. Jasper, welcome back to Australia. What brings you here this time around?
Thanks, Jordan. Great to be here. So I was only here about 6 weeks ago actually at your event, which was a superb event. So congratulations on that and thank you for having me to that. This time around I'm around with John Reid. We've got a forum down in Melbourne. So when I come down, I try and structure the trip. So I see some investors up here in Sydney, and then I'll see a couple in Melbourne as well around that forum.
And what's the forum? It's an investment forum, presumably?
Yeah, it's an investment forum. It'll be for asset allocators within superannuation funds. One of my roles is to get out and meet those guys and ladies and really put the case to gold to them to understand their portfolios, understand how gold can help solve some of their problems.
Right. So here at ABC Bullion, our client base in Australia, we have a lot of self-managed super funds that manage their own portfolios, but we also have a lot of clients, and of course our staff as well, who have money going into compulsory superannuation. They don't have self-managed super funds, so presume I'm right to assume that these asset allocators are the people that work for the companies managing that money and choosing what share goes into fixed income, what share goes into equities, and hopefully what share may find its way into gold, pretty much.
Yeah, that's exactly it. So you're either going to have a self-managed fund and then you have control over what you're investing in, or if you are one of those guys who just ticks the I'll leave it to the professional
default option or
yeah,
whatever.
Exactly, default option. Then we'll go into one of those funds, and those funds invest across multiple assets. The kind of cliche would be 40% in fixed income, 60% in equities, a kind of balanced portfolio like that. The interesting thing about really the world post-COVID and the inflation world we're in now is that those portfolios are struggling a bit. So last year you'd have seen a decrease in your equities, maybe 14% in Australia, and then a 9% decrease in your fixed income.
Yeah.
Those things are supposed to balance each other out.
They didn't last year.
Yeah, so they didn't last year. And the interesting thing about gold is that it's a diversifier. So it's something that can behave differently in your portfolio whilst also giving you returns over the long term.
And I suppose the hurdle for these funds has presumably gotten a lot higher in that, if you've got a target of inflation plus 3%, well, if inflation's at 2, you've only got to get to 5, but if inflation's at 5, you need to get to 8. So not only are the assets that they typically hold maybe not performing as well, but the hurdle they've got to jump is becoming more challenging.
You're absolutely right. There's a few things. I think a lot of them are moving more towards ESG as well, and that's starting to narrow the kind of breadth of investments they can get, particularly in an inflationary environment, because a lot of those inflation protectors are things like natural resources.
Sure.
When you invest in natural resources, you've got to be aware of the CO2 emissions and things like that are coming out of those mines or whatever it is that you're invested in, right? And I think a lot of them kind of shy away from that, but then that starts to detract from their performance. So they put themselves quite a difficult spot, I think, in that area. But that's not a criticism. I get the problem.
Sure. And gold's got a bit of a role to play there from an ESG point of view, and you guys have done some research on that, correct?
Yeah, we've done a lot of work in it. We think it's a really, really important area. We've looked at the CO2 emissions that are members, right, who are gold miners. So what are the emissions at each of the mines? And then once we know what they are, which we have measured, is how can we reduce them? So what can we do? In fact, I'll be back in Australia in November. I'll be visiting a mine in Western Australia. That mine has got solar power. It's got wind. Look, if the sun doesn't shine and the wind doesn't blow, then they need to have something else. I think they've got a bit of nat gas.
Right.
But in terms of the kilowatt sort of cost for their mine, 24 is what they pay from the grid. 20 is what they get at the moment with their solar panel and their wind. Now, if they pay that down, with the gold prices being where they are at the moment, they are making good money. They reckon they can get their cost down to 4 cents a kilowatt.
Yeah,
and
right.
so look, I just like that because it's an example of someone reducing CO2 emissions, but there's a business case for it too.
Sure.
And so a lot of members are looking at things like that. So that, I would say, is quite an Australia story, the CO2 emissions and that environmental story. Other parts of the world, like Africa, it's really the social story. So
one economic development.
Yeah, totally.
Sure.
Yeah, exactly. One job there in one of our member companies will produce another 6 jobs.
Sure.
Down the chain. So there's a huge amount of good that the members are doing just by being there. And in fact, getting to that environmental story in Africa too, the kind of power profile, environmental profile of the power production in those emerging market economies is kind of quite CO2 intensive. Then you've got our members moving there to places like Burkina Faso, Mali, where they're building again these solar power energy sources, which don't only go into the mine, but they actually start tapping off into the towns as well. So our members are actually contributing to lower CO2 profiles in those emerging market countries too. So it's a good story.
Yeah, it's really interesting. I think maybe I'm oversimplifying, but I think for a lot of people, for the last 10 years, ESG has really just meant E, but actually the other two elements of it are just as important. And I think I think it's a great story that gold has, and gold's not obviously the only asset here, but the role that it can play providing economic empowerment, particularly in emerging countries and emerging parts of the world, is a really powerful story. Going back to the institutional investor market, which is obviously where you focus your time. So what would you say is the sort of sentiment toward gold as an asset class, as a diversifier in a portfolio right now? Sort of really distinctly looking at that subset of clients or potential investors, as it were.
So in the institutional space, it's kind of interesting. I'd say gold drew in quite a lot of attention and drew in quite a lot of investment during COVID. Sure. Yields very, very low. This idea that the correlation of bonds and equities, which actually took place, so looking for some kind of diversifier. So we saw quite a lot of clients come into gold, and I think a lot of them approach gold from a tactical perspective. We're going to buy 5% in gold, and we're going to probably get out of it again, but we'll hold it for a year, however long. Why would they do it? Then they kind of felt that they were guaranteed to lose money on fixed income, which, by the way, nothing's a guarantee, but they did actually call that right. A lot of those that then sold a bit of their fixed income went into gold. So fast forward to today, a lot of those clients are still in gold. And I found that really interesting because their rationale for buying gold was low yields. Yields are really high. Well, certainly, whatever they are, 4 or 5% in Australia.
10 years.
So why have they kept onto it? They've kept into gold as a risk mitigator. So they're now starting to say, okay, it diversifies. There's other risks on the horizon that I really don't know how to deal with. Geopolitics is one of them. Physical risks and climate change is another one. These things are starting to affect the economy.
Sure.
And so they're holding on to something like gold.
Sure.
To help protect around that.
Sure. And I guess there is an element too where whilst those higher yields on fixed income securities in theory make them more attractive to allocate to now, for as long as those yields are rising, there's a mark-to-market loss you've got to wear, right? So, if you've been, I know John and I were talking about this separately, but if you've owned particularly treasuries at the longer end of the curve, or not just treasuries, you're sitting on some pretty substantial losses over the last couple of years, whereas the drawdown in gold is far less significant over, let's say, the last 2 years as a whole.
Yeah, I mean, I would just add on to that. It's that drawdown that's actually created some of the risks in the market. So,
sure.
Silicon Valley Bank is a classic example of that, right?
Sure.
So it's worth noting that as the rates go up, there are other risks poking their heads up.
Of course. And I suppose one question I'd ask, just because I know you spend a lot of time in other parts of Asia, based in Singapore, is there something distinct about how Australian institutional investors are looking at gold versus the way a pension fund in Tokyo or Singapore or Hong Kong might be looking at it, or are they all sort of looking at it through a pretty similar lens?
No, I think you're right. I think there are differences. If I started with Australia, I mean, you've got things that are unique to Australia that do make holding gold arguably a little bit more challenging for one of those, what did you call them, default funds.
Sure.
That's your future, your super.
Sure.
So gold is in this other category. It gets benchmarked against sort of 50% equities and 50% fixed income. That's quite difficult for gold because gold just doesn't move like that.
Yeah.
So, or to put it another way, gold could massively outperform that in 1 year, which it would have done in 2022. In another year, it might not. But there's no correlation there. So it's quite difficult for a professional manager to hold gold against that and then be judged
measured
on how it did. So it makes it quite difficult for them here. So I think that is very much unique to Australia. In the wealth space here, I think gold is pretty popular, and we've seen a number of wealth managers here increasing allocations actually just over the summer. And I think that has parallels with other markets. But I'd say your future, your super, is very much unique to Australia. Moving to somewhere like Singapore. Singapore investors are very, very long term. So they've got their eye on these long cycles. I think people like Ray Dalio are very influential there. And we've seen a lot of allocations coming through around that region. So the Central Bank of Singapore has been allocating that's public knowledge. They bought 60 odd tons this year. A lot of the other institutions within Singapore that are government related, some of the pensions, things like that, they're starting to add gold, endowments, and we're seeing them adding gold in. And I think they really have their eye on the future. They're also very conscious that Singapore sits between US and China, so from a geopolitical angle, it's kind of a nice hedge for them.
Sure.
Looking up to Japan again, really interesting thing, quite unique things that are going on there. Like, people get excited when the 10-year yield gets to 0.79, right?
Yeah.
The yen. I always think of the yen, right? Just go with 100. Divide by 100, you get the dollar price.
Sure.
It's now 150. Yeah. So there's been a massive weakening of the yen, and these guys are looking for other diversifiers to get in. We're also seeing a new generation coming in Japan. So the managers that have been running money, I'd say it's a pretty conservative society, right? They don't tend to do things that different to their peers.
Sure.
But I think there is now a sense that as that generation start to retire out, a new generation start to come in,
bring their own ideas.
Yeah, they are starting to look at gold. So we're seeing that, and actually, even from that perspective, we saw an uptick in the second quarter this year when other markets were a bit quieter, and I think that makes sense. And then you look at some of the tail risks in Japan, like the fact that the BOJ, Bank of Japan, central bank there, owns a huge chunk, probably over half,
quasi-nationalised
the bond market.
Yeah.
And people don't know how that's going to end. So
sure.
Just from that sort of perspective, I think gold has a role to play.
Holding something else that's liquid, globally traded.
Totally.
You'll always find a buyer.
And returning well in yen.
Yeah, very interesting. I might finish actually on something not institutional or not directly institutional, and that is, I suppose, more broadly, the World Gold Council's work on superannuation in Australia. So, you and I have been speaking for a few years now, and I know that you guys have done quite a body of work now. I think you've got a web page dedicated to, the role gold can play inside a super fund, SMSF or not. Did you want to maybe just finish with a couple of comments of that? Because that's very relevant for our audience, for our client base.
Yeah, so look, we look at different portfolios and different currencies around the globe. The research team does that. I think what's so interesting about Australia is probably your currency, and then the way that gold kind of fits into that. So gold in Aussie, over the last 50 years, compound annual growth rate, probably 8 to 9%.
Yeah.
Now, any endowment superannuation fund would take that.
Yeah.
Right. That's a nice return. So it's sort of interesting to see more of these guys looking at gold, because I think that does make sense. But what's really nice about gold in Australia is the diversification effect. Having sat on macro desks in London, right? The first thing you do when there's a risk-off moment, sell Aussie.
Sure.
And then what do? You buy yen, you might buy gold.
Yeah.
So not only does your currency drop at the same time that gold is going up in dollars, but it means it'll go up super fast in Aussie dollars. So it makes a really nice diversifier. And I do think from that perspective, more Australians should be looking at gold. And then, as you say, you've got things like the liquidity angle. We're seeing a lot of super funds allocated very heavily into equities, now starting to unwind that and move into fixed income, but also into private markets.
Sure.
And private markets, you really cannot get out of them if you need to or you want to at that moment without taking a big discount. So gold, again, liquid, nice long-term returner with diversification. Those things come together and you have a
lot of attributes.
It improves your what they say as the Sharpe ratio. So basically the amount of volatility you suffer per unit of risk you take. Right, the volatility comes down, the returns come up. So
sure.
Yeah.
Jasper, fantastic. Thanks so much for making the time today, and look forward to catching up again soon.
Jordan, always good to see you. Thank you.
Cheers.